Today, we are wrestling with a market movement that has really captivated and, let's be honest, terrified traders over the last 48 hours. I'm talking about the aggressive price action in the iShares Silver Trust, ticker SLV. If you were just glancing at the charts, what you saw looked like a total breakdown, a full-blown capitulation, really, the end of the uptrend. But a specialized analysis we're looking at today suggests, well, the exact opposite. That sharp price drop, it wasn't a crash. Not at all. It was a textbook high-stakes bear trap, perfectly designed to shake out anyone holding with weak hands, and the proof, that immediate, just fierce V-shaped recovery that followed.
That's absolutely correct. I mean, that dramatic price action wasn't just noise, it was a declaration by institutions. Our mission today is to break down exactly how that trap worked, psychologically, and how it turned all that volatility into, believe it or not, a powerful buy signal. And crucially, we're going deep into the three massive fundamental tailwinds. We're talking industrial scarcity, monetary hedging, and technicals that are fueling this. It's why institutional buyers are betting so aggressively that a retest of that crucial $72 price target is, well, imminent.
Okay, let's start with the drama, because if you glanced at those SLV charts, you just saw red, you saw fear. So walk us through the anatomy of this trap. What were the specific price movements that define this whole deception?
To really get the power of this reversal, you have to look at the intraday timeline. It all hinges on the $64 level. So the day started out positive enough. SLV opened strong at $67.35. It looked like, more bullish sentiment.
Just as usual.
Right. But then the script just completely flipped. What came next was an aggressive, really concentrated midday sell-off. It didn't feel organic. It looked manufactured. And this plunging pressure, it drove the price down, wiped out all the gains, and eventually pushed it all the way to $64.74.
But the real psychological damage, that was when it crossed that specific threshold, wasn't it?
Exactly. The previous day's close was $64.42. That level was acting as this key short-term psychological boundary. So when that aggressive selling pressure broke down into the $64 handle, it did two things. First, it absolutely triggered stop losses from retail traders. And second, it gave the bearish traders all the confirmation they thought they needed.
So if you're a short seller, you're watching that level break, and that's your signal. You're thinking, okay, the uptrend is officially broken, time to pile in and short this thing.
Precisely. They started shorting aggressively. They were convinced they'd called the turn. And this flood of shorting volume, it helped push the price even lower for a moment, confirming their bias.
But that's when the trap sprung.
That is the exact moment. The institutional buyers, what some call the smart money, they weren't seeing a breakdown. They saw a massive discount flashing on their screens. They immediately recognized that the $64 level was being tested by, frankly, short-term fear. So they stepped in with massive, sustained buying orders. And that aggressive, coordinated buying, it didn't just stop the fall. It rapidly overwhelmed the short sellers who had just jumped in.
And that's the classic short squeeze. They bought up all the supply. The new shorts have to buy back to limit their losses, which just pours fuel on the fire.
It was stunning to watch. The stock just reversed direction violently. It didn't just stabilize it. It rocketed off the lows, rallied hard for the rest of the day, and finished at $65.75.
A gain of over 2% for the day.
A gain of over 2%, despite spending the middle of the day looking like it was completely collapsing.
So this rapid turnaround is what we need to focus on. Why does this single day, this one pattern, matter so much?
It matters because of the signal it sends. I mean, when an asset like SLV makes a sharp new low for the day, convincing everyone the trend is over, and then closes near the highs for that same day, that is one of the most powerful bullish reversal signals in all of technical analysis.
It's a total rejection of those lower prices.
It's a total rejection. It shows that all the selling pressure just evaporated at a crucial level, and the bulls took complete, undeniable control.
Okay, that transition point is key. But, technical strength alone isn't enough to justify a big run towards $72. How does this connect to the bigger picture? Why are the big institutions suddenly so aggressive about silver right now?
It connects because they aren't just buying based on a single candlestick pattern.
Yeah.
They're buying based on three massive fundamental drivers that really confirm this price action. And let's start with the first driver, which is arguably the most powerful long-term catalyst here, the industrial super squeeze.
Right, silver is, historically a precious metal, but this is where it gets really modern. What's driving this intense industrial demand? Is it just general electronics?
Oh, it's far from it. This is hyper-targeted demand. It's driven by the technologies that are scaling exponentially right now. The thing is, silver is the single best conductive material, period. You just can't build the future without it, and there are very few viable substitutes.
Okay, so where specifically?
The analysis points to two specific high-growth sectors. First, AI hardware electronics. As everything from servers to your personal devices gets more powerful and components get smaller, silver's conductivity is just essential. It's a core input for the microcircuits that power the entire AI revolution. Second, and this one requires massive volume, is the proliferation of solar panels. Photovoltaics. A single solar panel array uses a significant amount of silver paste. And as the whole world accelerates its green energy transition, the demand for solar is just skyrocketing.
So you have two massive global growth trends, AI and renewable energy, both completely reliant on the same irreplaceable physical metal. What's the actual supply constraint here?
The constraint is simple. Mines cannot pull physical silver out of the ground fast enough to meet this technology-driven demand. Mining supply is relatively static, it grows linearly at best, but industrial consumption is growing geometrically, and that means the physical deficit in the market is getting wider year after year.
So the institutions see this coming.
They see it coming, they know they're securing an essential raw material that is only going to get more and more constrained, and that makes the metal less of a currency hedge and, more of a critical technological bottleneck. That scarcity alone justifies buying these dips.
That makes a very compelling case for the industrial side. But let's move to reason number 2. The monetary side. I have to push back a little here. With all the uncertainty in global markets, why would large investors flock to silver, which is famously volatile, when they could just stick with gold, the traditional safety asset? Isn't SLV a bit too risky to be a real defensive hedge?
That is an excellent and a necessary question. The analysis argues that silver right now is acting as a kind of a dual-purpose trade that gold just can't offer. Yes, silver is more volatile, but that volatility is accepted because it offers massive growth upside, precisely because of that industrial super squeeze we just talked about.
Okay.
Smart money sees SLV as the perfect counter-volatility hedge for their broader portfolios. They're protecting cash against currency devaluation, global uncertainty, the classic reasons to buy hard assets. But, and this is crucial, they're also picking an asset that benefits from the very same technological acceleration, the AI and renewables, that could cause other parts of the tech sector to correct sharply.
So it's a portfolio optimization move?
It is. They get the defensive attributes of a hard asset, but they still have that high growth potential tied to these huge secular tech trends. They're willing to stomach the short-term dips like that bear trap because they know the long-term fundamentals are locked in.
So it clarifies the risk appetite. They're not looking for pure safety. They're looking for leveraged safety.
Precisely. Accepting risk for a much greater reward and one that's driven by a measurable physical deficit.
And finally, let's tie this back to the technical picture for reason number 3. We talked about the V-shaped recovery, but what about the overall chart structure? Is this asset positioning itself for a sustained push higher?
Absolutely. The technical structure is reinforcing the whole bullish case. It suggests that immediate reversal was not a fluke. That critical $64 support level, the one that defined the trap, it's holding like a rock. That level was severely tested, and the immediate institutional rejection of prices below it just confirms its strength.
So as long as it stays above that zone?
As long as SLV maintains altitude above that $64 zone, the overall long-term uptrend remains completely intact.
So how does this big, scary drop fit into the larger trend then?
The drop is being interpreted not as a scare, but as a necessary cool-down period. It's forming what technical traders call a bill flag pattern.
Okay, like a pause.
Exactly. Think of it like a marathon runner. They sprint up a hill, that's the initial sharp price rise, the flagpole. Then they pause briefly to catch their breath, digest the gains, that's the flag, before launching into the next even more intense sprint.
And the bear trap just accelerated that process.
It accelerated that clean-out process. It was necessary to clear out the excess leverage and the weak holders, preparing the market for the next leg up.
So given this rare confluence of, physical scarcity, monetary demand, and technical structure, what are the actual levels we need to watch? What should someone tracking this be focused on?
The forecast is highly specific. We have a clear line in the sand for immediate short-term support. That's yesterday's exact low, $64.74. A close below that would dampen momentum, but that $64 psychological support is still the bedrock.
And on the upside?
On the immediate upside, we need to punch through the high point from before the trap was sprung. That's $67.35. Clearing that signals that all the residual short-term selling pressure is gone. It's been absorbed.
And then the big target, the one everyone is watching.
The next major target, and the critical resistance level, is the 52-week high, $72.03. And if SLV manages to break and hold above 72, the analyst observation is very powerful. The path just clears out dramatically.
Really?
There is very little structural resistance in the charts until you get to the major psychological level of $80.
Wow. That sounds like an invitation for a rapid maybe even explosive movement once that $72 threshold is passed. So what's the prevailing institutional strategy right now?
It is the simplest strategy, but it's being executed with immense confidence. Buy the dip. Any pullback, any move back down toward the $65 range is being viewed as a gift, a final opportunity to establish or add to a position before that anticipated run to 72. They are not afraid of minor drops. They see them as opportunities.
That brings us to the end of our deep dive on SLV. To quickly summarize, the sharp volatility was a brilliantly executed bear trap. It was followed by a powerful V-shaped recovery that confirmed the bulls are in total control. And this bullish dominance is backed by a potent trifecta of drivers: the industrial super squeeze from AI and solar, the monetary hedge against global currency risk, and a reinforced technical structure that's forming a bull flag. The window to get in at these lower prices might be closing fast.
The immediate objective is clear. A definitive retest of $72 is the focus for the coming weeks. The message from this analysis is clear. Don't let short-term volatility, even drops that look designed to create fear, shake you out when the fundamental and technical pictures look this aligned and this strong. And here's an observation for you to consider, one that could fundamentally change how you look at this asset. Given that the industrial super squeeze is driven by demands from AI hardware and solar energy factors that fundamentally accelerate the world's technological and energy progress, this raises a really important question. Should you now view SLV primarily as an essential high-growth technology input rather than just a traditional defensive currency hedge? And what does that monumental shift in perception imply for the long-term, possibly uncapped ceiling of the asset? Something to mull over as you track that $72 target approach.